Look at this abstract visualization of market prices. To the untrained eye, these jagged, fluctuating lines moving forward in the dark look like complete chaos. They move in erratic zigzags that seem to defy any kind of logic. Most retail traders look at that chaos and try to find safety by following the crowd. They rely on lagging indicators like moving averages to chase a trend that is already happening. The problem is, by the time a lagging indicator tells you to buy, the momentum is usually exhausted, and you end up entering the position right at the peak. Market prices actually behave a lot like a physical rubber band. When price action stretches too far in one direction, it builds up tension. Eventually, it reaches a limit where it must snap back toward a central point of balance. Professional traders understand this elasticity. Instead of looking backward at historical data to see where the market has been, they anticipate the exact moment of maximum tension. They want to be positioned for the snap. This tendency for extreme price deviations to return to a central point is known mathematically as mean reversion. It's the gravitational pull of the market. To map out that exact snapback point, mathematician and trader Mostafa Belkhayate developed a tool called the center of gravity indicator. Because it attempts to project future reversal zones, it functions as a leading indicator. If you want to stop getting whiplashed by late entries, you have to shift your focus from reacting to past trends and start mathematically measuring the limits of the present market. This median curve cuts through raw market data, using polynomial regression to track fair value. Surrounding parallel bands represent standard deviations. When price strikes the upper band, exhaustion signals an imminent drop. A dive to the lower boundary signals a prime buying opportunity. By tracking these extremes, the indicator functions as a spatial map of exhaustion, pinpointing exactly where a price trend theoretically loses its momentum. If you look at the center of gravity on a historical chart, it looks like a flawless crystal ball. The bands perfectly encase every single past market top and bottom, making trading look effortless. But polynomial regression hides a specific danger in live trading environments. It is a phenomenon known as repainting. Watch this static COG channel curve. As an extreme data point appears on the right, the formula recalculates, physically warping the entire historical curve. The dotted line shows where the curve used to be. The perfect historical boundaries shifted after the fact. An illusion. If you blindly execute orders based solely on a price hitting these bands, you face catastrophic risk. As the gravity shifts and repaints, you can easily get trapped inside the continuation of a losing trend. Relying exclusively on spatial prediction is a fatal error. Mathematical boundaries in a live market are fluid probabilities, not solid walls. Surviving a repainting indicator means changing how you interpret it. Instead of an absolute hard trigger to buy or sell, those outer bands must be treated strictly as zones of high probability. To solve the repainting paradox, you have to anchor the spatial data of the center of gravity with an independent temporal momentum oscillator. The Relative Strength Index, or RSI, is a perfect fit. Watch this dual-panel chart setup for a short trade. As price strikes the upper COG band, the RSI simultaneously crosses the 70 threshold, flashing to confirm. The top panel isolates where the market is overextended. The bottom confirms when momentum collapses. Professional trading requires building multi-dimensional systems. By combining spatial boundaries with momentum confirmation, you can safely navigate the chaos of repainting and master the pull of mean reversion. If you are ready to stop chasing the market and start anticipating it, subscribe to our newsletter for more deep dives into advanced technical indicators and